Hi, everyone, and welcome to our third quarter 2024 market update. Kristian, welcome. Happy Halloween. We're recording this on October 31st. Have you had any candy today?
None yet, but I'm sure there'll be some waiting for me when I get home. So looking forward to it and handing it
Fantastic.
out
Well, I
tonight.
can't have any candy, so I put another Splenda in my coffee. So that's how we're going to roll today. So, all right. So hopefully this won't be too scary for everybody as we go through our charts and our graphs. So I know you've been very busy putting these things together, and we went over a number of them to really, I think, try to show people kind of where we are. Some of the things we're focusing on, maybe some things we're not paying attention to or don't want to put any focus on. And we'll also talk a little bit about this thing that there's a big thing happening next week in the United States. Is there an election or something? I've heard.
Yeah, no idea what
I've
it
heard a bit
is.
about something.
Haven't
Yeah,
heard about it. Haven't seen it on the news. Yeah.
it's not a big deal. It's not a big deal. Okay,
Well,
well
we may or may not discuss this toward the end. But before we do that, quick word from our lawyers,
always they're
as
so
usual,
special to me. I love our lawyers.
and getting it. So this chart will be familiar to everyone that's viewed these presentations before. Just a quick update as to what occurred in the market this past quarter. And really what we've spoken about, Darren, is wanting to see a continued broadening out of the market. And that's really been evidenced over the last 3 months. As expectations for interest rate cuts continue to exacerbate throughout market expectations and the soft landing narrative has continued to take hold, other areas of the market have worked really well. So consumer staples, real estate, which is interest rate sensitive, utilities, also interest rate sensitive, industrials and materials, they all outperformed the broader S&P 500 over the last quarter. And technology and communication services, which are the year-to-date leaders outside of utilities, really lagged in the latest quarter. And so for those that run diversified portfolios such as ourselves, this has been a really positive development and one that we're hoping continues going
The
forward.
other thing I want to point out in this chart is not just the way leadership has gone,
Right.
but how important it is to stay invested because 2022 is not a good year across the board. So if anybody said, forget it, I'm throwing in the towel and jumping off the boat and I'm going to swim for shore, that did not work out very well. The right thing, as always, as ever, is just to stay invested. And we're seeing such really good returns this year, which is really just we're coming back out of the hole a little bit from 2022. So point to point, we're in a good spot. Because we don't really go down as much in markets when they go down, which is one of our patterns. But I think it's just a reminder of how important it is that even if there's a crummy year, just keep your head and arms inside the ride at all times. And this validates that rationale we have, which is why you got to stay invested. So, okay. So with that, moving on.
Yeah, and speaking of staying invested, certainly we're still cognizant of where valuations
Yes.
are within the marketplace. They are still high at 21 and a half times multiple for the S&P 500. And it's not just the top 10 that's driving these excess valuations anymore. Over the last quarter, as we've seen the pickup in some of these other areas of the economy and other sectors, we can see that the remaining stocks now are trading above their historical average. So what's really driven some of this outperformance continues to be the price side of that PE multiple, as investors gain greater optimism about other areas of the economy.
Yeah, and as we talked about before, that those top 7, top 10 stocks are still massive overweights, and they're pulling everything up. So that momentum effect that they have continues. We're going to talk a bit about why that is still concerning, and we have to manage around it. But we can see that their valuations, which in some ways, the businesses are going great. So investors are paying massive premiums for those businesses, and they just continue to power everything forward. So my analogy that everybody's putting quarters in the same slot machines or crowded around the same roulette table remains to be still true. So.
Yep, and we'll get to a chart on the Mag 7 as we usually do. But before doing that, we've continued to evaluate U.S. equities in a pretty confined context. And I want to just take a step back and see globally how they perform and where valuations are. So certainly they do look expensive, even to their developed market peers. And we can see that by the chart in the middle and the chart in the right. But there's good reason for that. Earnings estimates for the U.S. Constituents continue to be far greater than those of their peers. So if we look at the chart on the left, that gray line, there's a massive delta between other economies, such as in Japan, Europe, and emerging markets. And really the reason for that is U.S. economic exceptionalism. So real GDP differentials between the U.S. and Europe are over $2.5 trillion USD. And so that really buoys the support for extended growth above the other markets in global economies. So while things do look expensive, and Darren and I will look at things on a global basis to continue to extract value, there at least is a reason for why U.S. economic growth and U.S. equity markets continue to
Yeah, and
outperform.
on that topic, for like the last 15 years, I regularly get updates from global strategists saying, this country looks like it's a better valuation of the United States, this country. And my attitude has always been like, for all of its problems, the United States is still the best house on the street in terms of capital markets. And so if we do invest globally, it's because we want specific industries or businesses. But in aggregate, if we look at the geography, we've been right to stay on a U.S. Centric or a heavily U.S. focus in our portfolios.
And so, speaking about the Mag 7, which again continues to pull the market, they continue to contribute relatively more to the gains year to date than their peer group. We can see that their share of returns year to date is 45%. That's come down marginally since we looked at this last quarter. It was 51%. So it's come down 6%, which again reinforces a little bit of that broadening out theme. They still constitute a much larger weight in terms of the top 10 in the S&P 500 than really at any point in time over the last 25 years. But their earnings growth continues to be quite robust. So right now, as we're recording this video, we're in the midst of earnings season. We've had a few constituents report earnings last night, the night before, and one last week. Earnings continue to be coming above expectations. And so these entities, as Darren has spoke to, and we've talked about in the past, they're extremely well capitalized. They're generating tremendous free cash flow. Their competitive advantage relative to their peer group continues to remain intact. And so that earnings power has continued to be supported. There's been some continued trepidation around capital expenditures going forward for these businesses and the rate of return that they can generate on them, because they are quite large as a percentage of their total cash flows. And so that's something that we're going to continue to watch carefully. But these are still phenomenal businesses. And, another point we want to make, Darren, here, when we think about things in the global context, and even though these entities are domiciled in the U.S., these entities generate revenues from all over the world. And so despite just being U.S.-based entities, they continue to have a diversified revenue path, which has also contributed to their growth prospects.
So just a couple more thoughts on this. The first is that the ride is not straight up with these. So for people that want to load up on, and we've been very balanced in how we've approached this. I think we've been very thoughtful and mindful and prudent about risk. But for people that want to load up on these, it's been a heck of a ride. And just look at the top chart on the left, which shows that in 2021, they had a great, the Magnificent Seven were up 40%, so phenomenal, big return over the market. But then in 2022, you rode it a heck of a way down. You lost 40% of your return. A lot of people would have thrown in the towel there. But then they're up 76% in 2023, and they're up again 36% today. So it's not a smooth ride, and we're all about managing risk, and that volatility is now baked in that cake. So people need to know that this is not a free lunch. There are no free lunches. The other thing I'm going to mention is, I'm an old school value investor. That's been my programming. And a lot of that comes from Larry Sarbit, who some longtime clients will remember. Larry's retired now. Larry was a very, very successful U.S. stock investor. He ran a number of mutual funds and had tremendously positive returns back in the 2000s and the 1990s. He really saved us. And clients that have been with me for 20 plus years will remember this. He really kind of saved us in 2000. He kept all of our capital safe when everybody around him was losing 20 and 30% of their money. He helped us again in 2007, 2008, where again, he protected us from the downside risk. And Larry's a huge devotee of Warren Buffett. And one of the things he's taught me is how to look for companies that are wonderful businesses. And there's a bunch of criteria that define a wonderful business. So Larry and I have been having a number of chats, and we've recorded a few of them. We aren't releasing them quite yet until we're done. But he and I have been kind of looking at each one of the Magnificent Seven stocks through the lens of, is it a wonderful business? And we're not going to talk about the price of the securities, because what people are going to pay for the business is a secondary consideration. But the first thing is, if we go through those seven, do they meet that criteria that Warren Buffett laid out years ago of, are they a wonderful business? And I think as we go through the list, I think people will find this quite interesting, because some of them are not. And if you're going to start being a long-term successful investor, you have to start, in my view, with find wonderful businesses, then figure out what price you want to pay for them. So that's been a fun little side project I've been doing. And when we've got it to share, we'll let you know how to find those. But those have been interesting conversations as we've gone through them one at a time. So more work to come on that you guys will hear about. But that's been a fun project to get reconnected with Larry, give him something to do in retirement, which has been fun for Beta and for us to benefit from that wisdom. So, okay, moving on, Kristian. Thank you.
Yeah, well, looking forward to hearing those. And so we've talked about the equity markets. What we really haven't touched on is also the bond market. So U.S. corporate spreads remain increasingly tight. And so that is the compensation an investor will get for investing over and above a U.S. Treasury bond into a corporation, so the credit risk that they're taking on. And we can see on the chart on the right here in the U.S., these spreads are the tightest they've been since the great financial crisis. So what does that mean? Well, for one, it does reflect the increasing investor optimism that we're seeing not only in the equity markets, but also split through to the fixed income market. So that soft landing narrative really is baked into the cake on both sides of the puzzle. The other thing it means to us is really, we have to look diligently at extracting value across our entire book. So not only the equity side, and we spoke to how valuations there remain quite extreme, but also in fixed income is becoming increasingly difficult to find value given where valuations are. And so that's just given us another added task to be able to deliver returns at a reasonable price given where things are on both sides of the book. And so we've talked now about the markets and really what has fueled this soft landing narrative. For one, inflation expectations continue to come down, and we can see that most measures of core inflation have come down quite considerably within the U.S., and there still is some disinflation within the pipeline. So new tenant rent index, again, as a leading indicator for PC housing, which is a large component towards core inflation, that indication there is that's still going to continue to come down. And so while there are some areas around the margins that could contribute to elevated inflation, really, by and large, we still see a disinflationary tone towards the inflation picture in the U.S. On top of that, if we look at interest rates, really this has oscillated quite a bit. And the one area I want to focus on really is this gray band. So when Darren and I had this conversation 3 months ago, those dotted lines were at the bottom of the band. So there was really a ton of optimism around interest rate cuts. If we had this conversation 6 months ago, we were operating at the top of the band. So there's been tremendous volatility within the fixed income market as a result of changing interest rate cut expectations. A really noticeable development now, where we've kind of middled out here, is that if we look at that green dotted line, the long end of the curve, so that's long run terminal interest rate expectations, have flattened out. And Darren and I have spoken to this occurring where we felt that long end rates had a capacity to remain relatively more elevated than they had in the past, that we could settle at a higher level. And the reasons for that were things such as secular changes in inflation, possibilities for productivity, increasing the potential growth rate of the economy, so the neutral rate of interest being affected as a result. And so we've seen that play out as of late. So the curve was like this, it was inverted, there's a little bit of convexity in there, but now it's really just steepened. So we've come down a bit on the short end, but that long end has remained really stubborn. And that's had effects, and we'll get to this, through many areas of the economy, such as mortgage rates.
Yep. No, you're right. We've been fairly conservative on it. We knew rates were going to fall. We have not been at the aggressive end of how far they'd fall. So I think we've been, our cautious approach has been, turned out to be at the accurate one.
Exactly. And so when we think about this soft landing narrative in the U.S., and part of that was the inflation narrative and interest rate cuts refueling the economy and growth, and there is still some capacity for cuts to continue. But again, it's really leveled out on the long end of the curve. So so the market is now coming around to the idea that interest rates will ultimately settle at a higher level than they have in years past. So when we think about this in totality, really everyone now seems to think that there's going to be a soft landing, but we still have to be cognizant of tail risks to that narrative. And one of those is the U.S. labor market. So the U.S. labor market is still continuing to show signs of slowing. So job openings now, they were revised in August downward, and we'll have a comment on government
I was
data
going to say we've got a few more. We've got a few more slides on revisions, which makes this even harder.
But they revised downward for August. They continued the downtrend here in September by a few 100,000. And so that job openings rate is now around 4.5%. And a voting member of the Fed, Governor Waller, has indicated that it's around this level that we could see a significant rise in unemployment begin. And so that is something that we remain quite aware of, given the fact that when unemployment begins to increase, it's very rare that it halts quickly. And that's something I just wanted to show here on the chart on the right. So on the chart on the right, if we just look at inflection points where if we're looking across that dotted line in each of these charts, if we look at inflection points where it's gone above this dotted line, there's really not many instances throughout recent history where it's automatically just stopped. It's continued to rise because there is a bit of a feedback loop. If we think about it, if an individual becomes unemployed, they're unable to find work. That means they're unable to spend and consume in the real economy. So corporations all of a sudden are taking less income because consumers are not spending. And in response to taking in less income and margins falling and net income falling, they have to lay off more people. So there's a bit of a feedback loop that arises. And so that's something we just really want to be aware of, because right now we've had the longest sub 5% period of unemployment within the U.S. In the post-war era. So all this taken into fact that we just want to be still aware of the risks that remain in the economy and not just look at everything through rose-tinted
and
glasses.
Actually, that terminology, the economists would call that feedback loop, as you say, when it rises above the line. They would call that velocity. And I mentioned this in a Walking with Charlie a few years ago. Actually, I'll see if I can put the link to it up here for everybody, where I talked about the measure of inflation is money supply times how fast it's moving through the economy, which is this concept of velocity. And just to remind everybody, when the world shut down and you couldn't really go anywhere and buy anything except maybe toilet paper, or hopefully your Amazon account still worked, velocity went way down. So they had to keep printing money to kind of keep the machine going. And so now what we need to be worried about is not just how much money's in circulation. They're trying to bring that down with higher interest rates. But now we're starting to see the velocity start to go back down again, which is what that chart, the inverse of that chart, basically. So as unemployment starts to tick up, as you said, there's an effect that happens where people don't have as much money because they're not working, they don't spend as much, companies don't earn as much. This is the problem. So if the money supply is one thing, but the velocity of money moving through the economy is the other thing, the car just starts slowing down, and then because it's slowing down, it slows down more, and then it slows down more. This is a problem. So that's a very important chart that we're keeping an eye on. So thank you, Kristian, for finding that as another thing on our dashboard.
Yeah, and so when we look at the consumption picture, the other area we want to touch on is savings. And this is an area Darren and I have spoken about in the past, because the saving rate to us looked extraordinarily low. And we're wondering here, where are consumers going to be able to continue to spend from? On the chart on the right, we see that those excess savings built up through the pandemic, well, those are fully evaporated. But what's happened here over the last month or so is that the Bureau of Statistics in the U.S., they went back and significantly revised gross domestic income calculations, which meant that they went back and said that people were actually taking in a lot more money than they had initially said they were. Their consumption remained about the same. And so if you net that out, that means that people were actually saving more money than they had initially indicated through their releases. And so the savings rate, it looks very, very low compared to historical standards when we looked at this chart a couple months ago. Based on recent revisions, it's now about the average. So that has capacity to support some consumption in the interim. But again, there's really not much room for this to materially fall lower, just given where it is relative to historical averages.
So, and again, more revisions. So we're going to come back to this in a second.
Exactly. There's always a revision, which
that
was
good news, by the way. That revision was good news.
Yes, there was. And so now that we've looked at savings and we've looked at the labor picture, we've talked about the three pillars of consumption before. That last one is really borrowing trends, and so consumers' capacity to take on debt to fuel consumption. And when we look at that, we'll start on the chart on the left here. Household debt service ratios continue to tick up.
But
No
still,
surprise with the higher interest
but
rate
importantly, still
environment.
low. I think that's important that we know they're still low.
Importantly, still low
Yeah.
relative to history. And there is cash on household balance sheets to support these debt service payments. So that's not too much of a flag yet. But we are seeing trends of flows into early delinquency. So loans that are becoming delinquent or defaulting on loans. Auto and credit card, we can see those have risen quite considerably over the last few months. And really, credit card debt growth is set to slow further, and it has been slowing. And that's because credit card interest rates were really as high as they've ever been. So the capacity for consumers to borrow on credit and credit cards became very difficult. And so now we're starting to see that come down, of course, because consumers can no longer burden that level of interest expense. And the other area where we're seeing interest costs beginning to flow through the economy, and the transition effect is a bit slower in the States because they've turned out most of their mortgages. They have 30-year term mortgages, and a lot of those were renewed through the pandemic at lower rates. But over time, there are consumers that have mortgages that become due that they need to renew. We have new entrants into housing, and so they will need to take on new mortgages. And the end effect is, we talk about long end rates remaining high, and those feed through mortgage calculations. Interest rate costs for those with mortgages outstanding are also beginning to tick up. So in totality, we're seeing the consumer and their capacity to borrow being a bit constrained, especially among tighter lending standards. And some of these interest rate costs are beginning to hit their pockets. This is most notable as a read-through through recent earning results. And we've seen this over the last couple of quarters. There's a really large disparity that's formed between lower income households and those in the middle and higher income tiers. So lower income households have begun to cut back quite extensively on their spending patterns to help service some of this debt. We've not really seen that flow through to middle or higher income households.
The other thing that jumps out at me on this chart is on the bottom left, if you look at the orange chart, the orange line, a lot of people should be sending President Biden a thank you card for dealing with their student debt. So student debt delinquencies have gone. There's other people that might not be happy that the taxpayer is picking up the slack of that, but interesting to see just how that political move of paying off or having the taxpayer take on a lot of student debt has really changed that particular chart. So just a little fun fact there. Okay, moving on, sir.
So we've touched on the economy and we've also touched on the markets a bit. But really, one thing I wanted to highlight, Darren and I spoke to this last time, was the capacity for volatility to remain a bit higher than it has been over the last few months. So if we just start on the chart on the right here, we can see that the volatility index, so that's the broad measure of volatility, that settled at a higher level than we were within June. So we had that massive spike in August, and it's now settled at a relatively higher level. So we've had more volatility in the markets. And as a technical trend, we're making higher lows within this chart. So that means the trend is generally up. So we expect volatility to persist, of course, over the coming months. We are in the middle of an election cycle that is to end soon, but could have persistent volatility thereafter. But the broad theme of volatility becoming re-ingrained in the market has occurred. And so much for that August crash. Darren and I also preached about having some patience and calmness around the volatility that occurred within August and the flash crash on August 5th, as well as some of the yen unwinding and such. And we talked about in the last video, if you're curious about a few factors that led to that. But really, the market continued its uptrend and we made new highs in the middle of October here. And so despite the enhanced volatility, the market continued to perform quite strongly.
Yeah. And as my finance professor said back a long time ago, the problem with volatility is that it's volatile. So, and it's not like there's anything going on that would cause this to be volatile, right? It's not like there's any wars going on around the world or anything, is there? No, there's a little bit of that. And there's something else that's happening, like economic activity. I think we're going to turn to Canada now, right? In terms of how we're doing at home.
Yeah, so we're gonna bring it back home for just a minute, and we'll get to what's on everyone's mind in a few minutes here, which is the U.S. and the election.
There's an election in the United States? You should tell me these things, Kristian. You should make me aware of these little factoids. A little note to me would be good.
Bringing it back to Canada here, though, monthly GDP continues to be quite tepid. We had a reading this morning that indicates that quarter-over-quarter GDP growth in Canada is likely going to undershoot the 1.5% expectations released by the Bank of Canada. This is well below what should be long-run potential of at least 2% in the economy. And we've spoken really to the poor standpoint that Canada's in from a production capability, and we've also indicated the significant immigration that's come into the Canadian economy. And so despite those, and really, if we remove population growth from the equation, Canada's GDP continues to lag its G7 peers and is really at the bottom of that rung. And so the forward indicators for GDP within Canada continue to remain quite muted. We saw a little bit of a pickup here on the chart on the right if we're looking at the teal line. But really, it's well below expectations. The Canadian economy continues to kind of tread water. And really, that's been shown through a couple of lenses here. One, the economy has really not absorbed the employment that would otherwise be indicative of our population growth and labor growth in recent months. And we do expect unemployment to continue to rise within Canada. And a really good indicator that's highly correlated is hiring intentions from corporations. So those continue to trend downward, and you can see here on the chart on the right, they've been highly correlated over time. And so we do expect unemployment to continue to rise. And Darren and I just talked about what kind of feedback loop that could have on the Canadian economy. And as a final point here, when we're looking at inflation trends within Canada, there is capacity for the Bank of Canada to continue to cut rates quite aggressively. So they have this backdrop of a weakening or muddling along economy, so they'll need to fuel some growth there. But on the inflation front, really we're seeing continued disinflationary pressures coming within range for the Bank of Canada's 2% target. When we look at selling price expectations, so that's corporate price expectations for their goods and services, those also continue to come down materially, and those have been tightly correlated to core inflation. And so if we look at the whole of the picture here, the economy remains weak or is weakening, inflation's coming down, and so we do expect the Bank of Canada to continue to be in a position here to need to cut rates quite aggressively. Right now, it's priced in about a 25 basis point cut at the next meeting. They just cut by a supersized amount of 50 basis point at its previous meeting. And so we'll continue to watch that picture.
But that has a cost, doesn't it?
It has a cost. And so we'll see on the chart here, we'll see some unwinding of that rise here on the chart on the left. So that's Canada's policy interest rate. But really, it's had a couple implications. And one that Darren and I have continued to highlight most predominantly is the effect on the Canadian currency. So this chart's flipped. This is US dollar versus CAD. So if you're seeing going up and to the right, that means the US dollar is appreciating relative to the Canadian dollar. And when we had this conversation 3 months ago, we indicated that we'd be really weary of any short-term appreciation in the Canadian dollar or depreciation in the US dollar versus the Canadian dollar, just because it really does appear that Canada continues to be in a relatively weaker economic state and have a greater capacity to continue to cut rates and increase that interest rate differential between the Canadian and US economies. And so the Canadian dollar right now is back about where it's high for the year at about 1.39. And really, we're not expecting significant weakness in the US dollar versus the Canadian dollar on a go-forward basis.
Sorry, just to spin that around, it means that the Canadian dollar's gotten, it had a little bit of a blip up. We were like, that's a head fake, and it's gotten way worse. And that really comes from a fairly, just for the people playing a game at home, our economy's not in great shape. It's weakening. They need to lower interest rates. Every time they lower interest rates, our dollar gets hit because the US can maintain higher interest rates. So if you want, and I know we're likely to go into an election cycle in Canada in the next 18 months or sooner. We'll see. You're going to hear a lot of noise from politicians about the market's great, the economy's great, this kind of. The data says another thing. So ignore the politicians. The data says our economy has not been great. We can argue about if the current administration have been good stewards of the economy. When they say they don't pay attention to monetary policy, the proof is in the pudding. And we're now going to be paying the price for this because it makes, and that back to the inflation chart, it makes everything we import into Canada more expensive. So I believe we're going to see a continued weakening of the Canadian dollar until there's some significant policy changes. And if they come, that's up to voters. But clearly, if interest rates keep going down, that'll help people with their mortgage payments and debt payments, of which Canada is way too high competitively around compared to other countries around the world, especially the United States. But it's going to come through in our dollar. And if you just want a global measuring of what people think of the Canadian economy, just look at our dollar, and our dollar is weaker. And again, we've maintained very high U.S. concentrations in our portfolio because we think the businesses are better there in aggregate than we find in Canada. But we're also getting a positive lift on the currency side too. So we'll just keep watching this, but I don't think this is going to be a great news story for Canadians unless we see some pretty significant changes. So, boo, Halloween, right?
And so bringing it around to the topic that we didn't know was happening, but turns out it is happening, and that's the U.S. election.
We just can't get away from it, right? It's so noisy.
We just can't get away from it. But as some quick comments from Darren and I on the election, where do we stand? And so, we've stressed in the past that we're not trying to predict the unpredictable, but we have to take data as it comes in. And so right now, the election is very much still within a toss-up range. Most polls are within their polling error amount. If you look into the betting markets right now, we've seen a surge in the odds that Trump will win presidency. And so that has a few outcomes here if we look to the chart on the right. So if Trump were to win the presidency, the most likely outcome actually is that the Republicans sweep all forms of government. Typically, the House will end up being in line with who is elected president. So if a Republican is elected president, you typically will have a Republican House, and vice versa if a Democrat is elected president. Within the Senate, it's actually very probable that the Republicans retake control of the Senate. Right now, there's far more Democratic seats up for re-election than Republican seats, and the states that some of those seats are up for re-election are those in such as Montana, which is a Republican-leaning state, as well as in West Virginia, where a centrist Democrat senator is retiring, and right now polls are indicating a Republican is leading there as well. So the most likely outcome in the Senate is that the Republicans will win the Senate, and then the House and the presidency, of course, still remains very much in a toss-up territory.
But no, by the way, I've been drinking coffee through this whole thing. Depending on how this unfolds at our next recording this, Kristian, I may be drinking straight out of the bottle. So we'll see what happens. There's a couple of other things, and I think this is actually really important because I think the media and the public are so focused on the White House. We have to remember the U.S. has got three components to their government, right? That's just the executive branch. We've also got the House, the Senate, and the Congress, and we've also got the Supreme Court. And the U.S. is all based on checks and balances. So all this talk of a dictatorship, this is all nonsense because nobody's actually going to be able to be a dictator because you're not going to get all three houses or three groups all aligned completely 100%. And that's by design. The U.S. doesn't really allow for that. But so it's important that we see, will the president wind up with a Congress that's supportive of policy and vice versa, or are we going to see deadlock? And I think that is really important. We need to look at all of these things together and which way the balls could bounce. So we just talked about if Trump wins, what do we think might happen? And I know that you've got a chart on this one next, a little more detail on if that's what the outcome is.
So if Trump wins, again, the most likely outcome is actually they do control the Senate and the House, although the House will likely still be by a very slim margin, so they'll still have to wrangle up votes to support policy. But nevertheless, he will likely have control of all three forms of government. And so, what is the likely outcome from a Trump presidency? And we'll just take his policy statements here at face value. One that is quite obvious is that a likely extension of the tax cuts that were enacted in 2017. So on the chart left here, we've spoken about continued fiscal spending, and really that's going to continue regardless of who's elected. So the blue line is Democrats, red line would be Trump if he extends them, because the Democrats have indicated they will not extend those tax cuts. And so there'd be a continued quickened pace of deficit spending in the U.S. from an extension of those tax cuts. The way to fund those, though, and really he's spoken about this quite extensively, is a renewed trade wars, which are likely, and certainly a blanket tariff being enacted globally towards their trade partners. And so they're going to look to fund those tax cuts with tariffs. The tariffs could also be used ostensibly as a bargaining chip to get more favorable trade terms with the U.S. and its trade partners. But nevertheless, if we look at investment implications of that, which sectors are least vulnerable to trade wars, which ones are the most vulnerable? And so right now we can see that utilities, they generate most of their revenue domestically, so they'd be least vulnerable. Something like IT or materials, certainly they rely on foreign trade partners and foreign revenue streams, and they'd be most vulnerable. So that's something we're going to watch out for closely. The other area is immigration policy. So Trump has indicated that there would be a mass deportation program for illegal immigrants, and certainly look to continue to stem the widespread immigration crisis that's occurring in the U.S. And so if we bucket all of those together, the tax cuts, the tariffs, and the immigration policy, the likely income is actually going to be net inflationary for the U.S. economy. So you have higher yields. It would likely lead to a continued appreciation in the U.S. dollar. And the other thing that we need to think about here is that some stimulus and tax cut extensions might actually have capacity to boost markets in the interim. And so we'll continue to think about that in the capacity of a Trump presidency. But really, the reason we want to have this conversation, and we'll get to Kamala Harris in a minute, is that we just need to evaluate, if this happens, what are the likely outcomes and how would that possibly impact our investment considerations?
And by the way, it's important that I think we note that it's really hard to figure out. I mean, all we can really do is look at what Trump did when he was in power last time. At least we have some degree of a track record to look at. But I've always argued that listening to Trump present is like listening to a professional wrestler predict the outcome of the next match. Like, there's so much showmanship, and just go back and watch some videos of Hulk Hogan or Macho Man, and you kind of go, yeah, that's what Donald Trump's doing. So trying to read the actual policy implications based on all the noise is tricky with him. I'd argue it's probably just as equally tricky with Kamala Harris, because I can't really follow some of her commentary and her suggestions and things, because I just get a little lost in her dialogue. But I think both candidates are not my favorite. So we talked about, so I think the first thing I take away from this is, if Trump gets in, we're likely to see trade wars, as he's going to try and right the balance of trade between the United States and other countries. So if you're an American, that might be good news, that he's going to go back and say, we need a better relationship. Maybe not so good for countries like Canada or Germany, but he's going to spend more money. He's just going to do it through tax cuts. Kamala looks like she's going to spend more money, but she's going to do it by handouts as opposed to cuts. So voters will decide which approach they like more. But let's have a quick peek at what we think might happen if she gets in, and that's the higher tax rates, and where might those hit?
Yeah, so again, if Kamala wins, the likely outcome will be some semblance of a split government. So they'll probably have the House and the presidency, and again, the Senate is leaning at this time towards a high probability being Republican. And so that will constrain a little bit in terms of their ability to enact widespread change to their policy. It'll be kind of more of the same in terms of what we've seen over the last few years here. But really, there's a couple key components of her policy statements that we can draw upon. One will certainly be letting those tax cuts expire. And certainly there's been a capacity on the Democratic ticket to want to increase effective corporate tax rates, and certainly tax higher income individuals more extensively. And so the way that feeds through in terms of investment policy decisions is which sectors would be the most affected from a higher effective tax rate. And so we see real estate at the bottom of this chart here, and then we have communication services, materials, et cetera, on the far left. And so that's one way that feeds through in terms of the investment implication process. The other thing to consider is that their stance on immigration is certainly not as hardline as the Republican ticket. It is a national issue in the states if you look at polling. And so certainly there is a willingness to want to rectify what is currently going on the southern border. And Biden's taken some steps to having this fixed in part through an executive action earlier this June. And we can see that on the chart on the right. Following that executive action, the counters at the southern border, so the illegal immigrants that are flowing through, where they're being encountered by Border Patrol, has come down a little bit. But certainly the tone and the language so far in terms of policy is that there would like to be an eventual path to citizenship for a lot of these immigrants that have come here into the U.S. illegally. And so what does that mean? That means that the labor force is likely to continue to remain large or growing over time, and that would be net deflationary, versus Trump's policy would likely restrict the labor force, and that would be net inflationary. The lack of tariffs embedded in our policy is also a big contrast versus Trump. And so if you take it all together, you will likely have weaker yields, possibly some semblance of less inflation versus Trump policies, and a weaker U.S. dollar as a result. And so that's something we're going to continue to be very mindful of. But again, the capacity for Kamala to enact change will likely be far less than Trump should he get elected to office. And so that brings us really to what can we expect from market outcomes. As we just spoke about, the markets really like split governments, and that's because there is less uncertainty when it comes to split governments, because no one person or no one party can enact widespread policy change. There has to be some semblance of bipartisanship on bills and new passages of law. And so over time, market returns have been highest for split governments. But those instances of Republican-controlled or Democratic-controlled trifectas, so the House, the Senate, and the presidency, while they do tend to indicate lower historical returns, we've actually seen them in recent history. So from 2017 to 2019, the Republicans controlled all three branches of government. And in 2021 to 2023, the Democrats had control of all three forms of government, because at the time the Senate was 50-50 and Kamala had the deciding vote as the vice president presiding over the Senate. And during those periods, equity market returns, just in recent history, have continued to remain very strong. So while we like to look to the past, if we look to the more recent past, certainly we're just being mindful that it's not indicative that we're guaranteed to have lower equity market returns.
No, that's true. And I think this is important that we look at this and go, this is an interesting note, but it could be, there's a difference between causation and causal. So we don't know if those two, if the markets were up because the politicians were a little handcuffed, or there were obviously many, many other factors going on. So it's interesting to note. I don't know if it's a prediction, but to be honest, I wouldn't mind if all politicians had to go home for a few months and not be able to touch anything and reflect on what they've done. I think that would probably be good for everybody.
Yeah. And the way we wanted to really wrap this up, because I think we know there's a lot of angst around the election outcomes. And, the chart on the left still showed that in every outcome, the U.S. equity markets still generate positive returns, just so we're clear. And when we look at average S&P 500 calendar returns, on the left, we can see in election years, it continues to trend up, and we are trending pretty closely as of now to where we've been in the past. We're also seeing more broadly on the chart on the right, if we had a full sweep, if we had no party change, the end result, many days later, many months later, is that the equity market is still in much more positive territory than from where we began. And so when we take this into consideration, really, our feedback here is we're going to continue to be really concerned or cognizant of what's happening, I should say, in the real economy. We want to be wary of some of the, yellow lights that we've indicated, but certainly the economy is going to be the predominant driver of equity market returns going forward. So that's really what we're going to focus on. And so when we talked about policy outcomes under each president, really the reason for that is because we want to see how could that affect the economy.
Yeah, and I think it's also important to note that some of the really powerful underlying trends that we're following, whether it's productivity through AI, aging demographic population, like there's the degree to which personalized healthcare is coming. There's so many positive things that we're happy about and we're investing in. Who's in the White House or whatever doesn't really affect it too much. It might change the course a little bit, but the trends are so powerful. This is still. And there's an obvious reference to who's running right now, but this is a bit of a sideshow. So we're not going to let it distract us too much. Obviously, it's there, it's in our face all the time, but we do our very best to turn the noise down, which is hard, given how loud the political cycle is in the U.S., and it's going to ramp up again in Canada. But I just want everybody to know that we try to see through some of this stuff, and I'm going to ask you guys to also. So the news channels are always full of noise, and try to turn them off and turn them down. The underlying trends that we think are going to play out over the next 2 decades are so powerful there's nothing ever goes straight up. There's going to be bumps in the road, and we talked about volatility, but we're really trying to focus on what those really strong currents are and stay aligned with those, and not get blown off course with some of the talking head stuff that we see on TV. So Kristian, thank you very much for digging into the data. I really appreciate the time and effort you spend to find those things on our dashboard. I'm happy to share with everybody so they can see kind of what we're looking at and the risks that we're focused on. And happy to share more as we go. So one other little quick update. I've kind of tucked into my little YouTube studio here. Pedro is in my office. We've run out of space in our Oakville location. We've signed a lease on a nicer, bigger office also in Oakville. Nobody wants to go to downtown Toronto anymore. They hate the cars, so I don't want to deal with it. And so we're having the place renovated. So fingers crossed we're able to move in. Everyone knows what contractors are like. So they do their best to stick to timelines, but you got to be flexible. So hopefully in the new year, in February or March, we'll be able to move into our new office, and I'll get out of trying to find a desk. So with that, Kristian, thank you for your time today. Thank you all for watching. Trick or treat, watch out for the little kids as they're running around. And by the time you watch this, it'll be over. So we can all go back to our Pelotons and try to work off those little candy bars that they somehow find their way onto my kitchen table.
Awesome. Well, thanks everyone.
Bye.